So you're thinking about buying your first home or maybe buying your next home. Well, that's great and congratulations. But before you go apply on the lender's website, you need to take a look at the mistakes that most people don't even talk about. And we're going to get after it right now. What's up, amazing people? I am Liz LaFleur here with the Mortgage Liz team located out of San Diego, California. And on this channel, we talk all about the best home loans for you and your family and what it's like to eat, sleep, live, and play here in San Diego. And if that's what you're looking for, then this is a channel for you. Make sure that you click that subscribe button and get reminded with that little bell, because it's really important to know when that next new video is coming out so you get to see what it's like to eat, sleep, live, and play here in San Diego, California. Honestly, my team and I are getting calls every single day with people just like you that are thinking about relocating or just moving to a different area here in San Diego. And we love those phone calls. So if you're thinking about relocating or just moving to a different part of San Diego, make sure that you give us a call, send us a text, or even an email, whatever is easiest for you. We would love to help you on this journey to your new best home loan, and we got your back when you're moving to San Diego, California. All right, amazing people. Today we are going to be talking all about it, the big mistakes. So we're not going to be talking about, oh, let's go get a home inspection or let's get a pre-qualification. I mean, seriously, you can Google that and get that basic stuff anywhere. No, we're going to be talking about the mistake that most people don't even know because nobody talks about it. So buying a home can be really, really overwhelming. It can be exhausting. I mean, like the amount of paperwork, seriously, even I get overwhelmed with all the paperwork because you're having to detail and find every single piece of document that you got to have to be able to finish your loan. And sometimes we just got to take it step by step, but also realize what mistakes that you can actually make. So before you go apply on a lender's website and have them run your credit and submit all this income documentation, we need to listen about what those 9 mistakes truly are. And regardless whether this is the first time or the 7th time, all these mistakes are relevant whether you're refinancing or purchasing that home. All right, so the first mistake on this is going to be allowing a lender or a real estate agent to tell you how much you should spend. I mean, seriously, we get all excited. Woohoo! We are getting our pre-qualification done, or we just got our pre-approval done, and now we are pre-approved for $1 million. Let's go shopping. That's great and all, but have you looked at the monthly payment? You know, have you looked at where all that money is actually going to come from? Typically what happens is that when you have a lender go do your pre-qualification, pre-approval, or just look at your numbers, they are looking at the top range. They're wondering what is the maximum that you can qualify for. They're not asking you what your comfortable payment is or, hey, what other obligations you have to pay for. They're not even talking about, you know, the childcare that you have to pay for. I mean, seriously, childcare in San Diego is ridiculously expensive. And so sometimes you really have to look at that stuff in conjunction with that mortgage payment, because we still got to send our kids to preschool, right? We still got to send our kids to all of their extra activities. And that information is not on our credit report. So first off, in that, making the lender allow them to figure out how much that qualification is going to be about, we start talking about, did they actually look at your income? Did you submit any income documentation, or did you just go through their website, go click, 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 and then have them run your credit, and then magically in 5 minutes you have a pre-approval? There's no information that's actually verified. So how do you know that you can truly qualify, number one, on that aspect for that pre-approval? But then also, how can you really know that you can afford it? Have you done your own budget? So let's talk about a little bit more about how the qualification actually is broken down when it comes to a lender. Okay, so let's do some calculations here. You have 2 different people, right? Husband, wife, right? They both work, have jobs. The husband makes $6,000 a month. Wife makes $5,000 a month. Total income, $11,000. Great income, totaling for the entire year, $132,000. Great income for here in San Diego, right? Well, now let's get into a little bit more as to what the qualification comes into as to how we actually run those numbers. It's going to typically try to kind of push the limits. I mean, like go to 50% or 55% of what you actually make. So remember, $6,000, $5,000, $11,000. So total income, $11,000 in gross income. Okay, that is how it is actually qualified for your new home purchase. So mistake number one is that you look at the 55%, which is what typical lenders, and if you don't know what I'm talking about, you need to take a look at one of my other videos that talks about how the debt to income is actually broken down. So on the $11,000, 55% of that is $6,050. And then on 50% of that, that's gonna be $5,500. So for this case purposes, we're gonna go through the $6,050, which is 55%, because everybody's always kind of trying to stretch the limit. Okay, so then we add in that cost of living. So typical cost of living is that we typically have car payments and credit cards and debt in general like that. So the typical household will have typically 1 or 2 car payments, sometimes even 3 or 4 car payments. But for this case scenario, we're really just going to anticipate 1 car payment for $600, okay? Typical car payment actually here in San Diego is about $538. So we're gonna go a little bit higher because we know that our average car payment's not usually $538. So next step is that we're gonna add in that credit card. So again, credit cards are actually pretty common. So $6,500 in credit cards, which is going to give you a monthly payment at about $150. So $150 plus the $600, now you're at monthly debt at $750. Remember, we have not talked about any of your nanny. We haven't talked about how your daughter is in softball and that they got pitching lessons, they got taekwondo. I mean, like none of that conversation is even on your credit report. So as a lender, all they're looking at is the car at $600 and then the credit card at $150. So going back to that income that we were talking about at $6,050, remember $11,000 in total income with the calculation at the 55% of debt to income, giving you that $6,050 left over minus your $750 with your car loan and your credit cards. So the $6,050 minus the $750 leaves you with $5,300. So on a typical aspect, you're going to have a lender that's going to run your numbers assuming that you can spend $5,300. But you know and I know that that calculation as to how much you actually get back is not right. Because that means that you're going to end up with a mortgage at $5,300 based on the $11,000 of gross income. But we all get taxed. And that is what is not calculated in that debt to income. And so we have to be reminded of that, because even though a lender is going to do 55% of that income, that means that you actually receive that. And you know and I know that that is not right. So what about the federal taxes, the state taxes? Because yes, here in California, we have both. Let's not talk about the retirement, and the medical insurance, and then what other stuff comes out of your paycheck. I mean, if we were just to average 35% of the $11,000, you're going to find a dramatic different number as to how much you're actually coming into your bank account and how much is actually available for you to be able to spend on your new home loan. So let's do those calculations. You make $11,000 a month. 35% of what is actually bringing into your house, that's actually going inside your bank account, is not going to be the $11,000. So 11,000 minus 35% on average as to what's actually coming in is going to be $7,150. So now going a little bit step further, remember we were talking about a second ago, that shows the fact that if you were spending the car payment plus the credit card and then the mortgage at $5,300, that totals $6,050. So the breakdown comes into $7,150 is what's technically coming into your account based off of 35% coming off of the top. And then you're gonna spend $6,050 with the mortgage, your car, and your credit cards. Do you realize you're gonna be left with less than $1,200 being able to survive here in San Diego, California? I mean, like, nobody talks about this. This is humongous, because how are you supposed to go pay your childcare? How are you supposed to go get groceries? How do you go to Costco? How do you, I don't know, pay your landscaper? How do you do your own landscaping? All of that stuff is not calculated when we actually look at the debt to income for 55%. This is what we call house rich and cash poor, my friends. I'm sorry, but it's the truth. And so this is the reason why I tell all of my clients it is not important, and it's irrelevant as to what you qualify for. What is the maximum that I can qualify for? Because let's think about this. You truly need to know what your comfortable payment is. Where do you want your payment to be? Your principal, your interest, your taxes, your insurance, your mortgage insurance. Maybe you have Melrose. Maybe you're going to have HOA. All of that stuff is what needs to be included inside of that comfortable payment. And then once you figure out what your comfortable payment is, you need to figure out what your maximum comfortable payment is. And so what I like to say is the Taj Mahal. Okay, so you find that home that's got everything you want to have. It's got the bedrooms, it's got the backyard, you're living in the cul-de-sac, it's got that 3-car garage that you got to have, perfect school district. What is that payment? So if your comfortable payment, for example, is $3,000, well then is your maximum comfortable $3,500 or is it $4,000? Well, what you need to do is break your calculations of what you want to spend off of a comfortable and a max comfortable payment, not based off of what a lender or an agent tells you that you should qualify for and the maximum qualification. Because let's be real, if you're looking at this high, humongous payment of $5,300, where is that lender? Where is that agent? Where is anybody that wants to give you advice? Where are they going to be when that first payment arrives? Are they going to be paying that mortgage? Probably not. And so we need to make sure that you are spending correctly to your own family. So that way you have enough to live on, enough to have a house, and still have that little extra cushion when you need the extra money when something happens. Because you know, and I know, life happens. There's always going to be something that's going to affect your regular income and the regular spending on a regular month. So on to mistake number 2, not having your money inside of your bank account that you actually need. So I'm not just talking about the down payment of 3% or the down payment of 3.5%. No, I'm talking about having your appraisal that can be about $500 to $600. Your physical inspection, again, $300 to $500. Let's not forget about maybe you're going to have to pay for a termite out of your pocket. Maybe you're going to have to renovate that house because it's not, doesn't have all the bells and whistles. Stuff like that is really, really important. Maybe you're buying a manufactured home and you have to be able to pay for the structural engineering report. Okay, all of that stuff has to get paid for out of pocket. It doesn't get financed when you end up doing a regular purchase of a home loan. When it comes to refinance, maybe that's a little bit different, but you still have to come up with this sorts of money. So don't just assume that you just need the 3% or just need the 3.5%, because in most cases, yes, you need that money. And yes, you're gonna need the appraisal, the credit report, the physical inspection, and all of that good stuff. But you're also going to need a padding. You're going to need reserves. You're going to need money inside of the bank account after you close, after you give those 3%, that 3.5%, the 10, the 20%, whatever the amount is for your down payment, you're going to need money left over because the bank no longer wants to see you spend everything to be able to buy your first home. Now, after COVID, it's really important that you have money left over because if anything like this or similar to it or life truly happens, you need to have that cushion. And let's not forget about the closing costs, because in this market, closing costs is actually really hard to get. Let's not be wrong. I mean, it is happening. I do have clients that are getting closing cost assistance and they are getting maybe 3% of their sales price. So let's say they're buying $500,000, 3% of that is $15,000. They are getting it, but they are having a tougher time in getting it because there are so many buyers and so little sellers in comparison to this market. With that being said, can you technically finance the closing costs, meaning that I'm just going to add it on top of the loan per se? No. I've heard a lot where my clients are, say, bribing per se, that they are paying the seller to be able to include their closing costs, or so that way they don't have to come up with it. You're gonna find that closing costs are going to run you about 2 to 3%. So remember what I was saying a second ago, $500,000, 2% of that is gonna be $10,000. 3% is gonna be $15,000. And so depending on when you close, depending on your insurance, and depending on your taxes, will depend on how close you get to that 3%. And let's not talk about whether you are buying down rates or not buying down rates. Meaning, are you paying extra today to be able to finance a lower interest rate? Or are you not paying extra today and you're getting a little bit higher of an interest rate? Things like that are all things that you need to find out in the very beginning before you actually go submit your application. Because if you don't have enough money, then why are you running your credit? If you don't have enough money, why are they submitting your application with your income and your assets when they should have been able to have the conversation with you about the actual important details that you need to have done before you start running your credit? So let's talk about that same bank account and having those assets. You need to make sure that you're not accumulating money while you're in escrow. So what does this mean? It means that when a lot of the time you're supposed to have, logically, the 3% down, right? You're supposed to have the $500,000 price, the $15,000 inside the bank account, the extra cushion of that monthly payment inside of your bank account. So let's say another $3,000 per payment for $6,000. 6,000 plus the 15,000, you need to have 21,000 in your total bank account. So yes, we have to have 21,000. Logically, you should have this when you submit your pre-approval application. And the reason why I say this is that I have had clients in the past where they are trying to accumulate this money when they are in escrow. And so how crazy is that you are trying to accumulate the $21,000 when you're in a 30-day escrow? One thing that you have to remember is that if you've been, let's say, thinking about purchasing a home for the last 30 days, 6 months, 1 year, how long did it take you to accumulate the $21,000? Did it take you 6 months? Did it take you 30 days? Did it take you a whole year? Were you only saving $500 a month and that's why it took you so long to recoup or to save your money? Well, then that's where you have to figure out whether that comfortable payment that we were talking about, $3,000, is it going to be feasible? Right now, you are paying, let's say, $1,000 in rent. And if you're paying $1,000 in rent, congratulations, because that is not common. But lately, I've been seeing a lot of my clients that are living with family, living with parents, and I've been saving their rent. And that seems to be like the magic number lately. So let's say you're paying that $1,000. So $1,000, the new mortgage is going to be $3,000. So the difference there is $2,000. Logically, you should be saving this money for at least a couple of months, $2,000 extra dollars into your bank account. So why do I say this? See, the problem is that a lot of the time you go through the process of going to go buy your home, but you haven't been saving the $2,000. And so you've been spending the $1,000 in rent, and then all of that extra money you've been spending on a regular basis for, let's say, the last 5, 6, 10, 20 years, however long you've had this income and the stability of this income of the $11,000 a month. What is going to change in the next 30 days where you are going to magically start saving an extra $2,000? Did you change your budget somewhere? Did you stop going out to eat? Did you stop spending your money at the mall? What exactly is going to change? If you haven't changed your habits, anybody is going to tell you that to change a habit, it's not going to be overnight. And so you got to be able to set that up in the future. So before you go submit your application somewhere, if you're telling the lender, hey, I'm comfortable with $3,000. Okay, my rent is $1,000. I have been continuously saving those $2,000. Is it a requirement? No. Is the lender going to say, hey, you haven't been saving this money for this amount of time? No. But to have a successful home ownership and make sure that it's not stressful within the first typically 3 to 6 months when you're trying to go from spending $1,000 to now spending $3,000, these tips are really important because these are one of the biggest mistakes that you're going to have if you haven't actually started saving. So on to mistake number 3. And mistake number 3 is not asking what could go wrong. We all like to buy cars, right? So when we go buy a used car, sometimes we'll go to Carfax, and in going to Carfax, we will go do all the extra investigation, right? We'll make sure that when the car is worth, we'll drive it, we'll take it to the mechanic, we'll have the oil change, like all of that extra stuff to make sure that the car is worthy of, let's say, the $20,000 price. Or maybe it's not worth the $20,000 price because something is broken or it needs new brakes or it had a car accident. All of these factors are something that we go and we look at and we dive in and we dig in on a $20,000 car. I mean, the amount of research that we do, whether this one $15 item that we buy off of Amazon is going to work or not going to work, and all the reviews that we have actually determine whether that's going to be the one $15 item that we actually buy. And then when we go buy a home and we do the home loan, we don't ask anything. It's like going to the doctor's office and you see that commercial where they have all of these ideas, just thinking, and then you get to the doctor's office and you ask nothing. It's the same concept. When you go buy, or when you're going to buy your first home and you're going to get that mortgage loan, you want to know what can go wrong. What things have happened in the past? What questions are you not asking? Are you going to be able to close on time would be like the number one question. When do you release out your closing disclosure? When you release your loan documents, are the loan documents sent out with a wire, or are they not sent out with a wire? When is the cutoff for your final closing? If I'm approved, what other conditions do I need? Besides those conditions, what else do I need to verify? When you first looked at my loan, did you look at all of my income and assets? Was there anything that you saw? Do I have to explain a bank statement deposit of $1,000? Do I need to go back because I had a negative withdrawal of overdrafting a check? Was there something on my tax returns where I had a job on there that I was sort of doing but not really doing, and I was using it for a deduction purposes, but it wasn't really bringing in income, but technically it's showing negative income? All of this stuff, things that could go wrong. And if things are not checked on in the very beginning, you're going to run into what I like to call Pandora's box during your process. And me, I don't like Pandora's box. And so I like to make sure that I do all of my digging, all of my research in the very beginning. Because in order to make sure that you have a smooth process, you got to do the legwork. You got to do your homework in the very beginning. You got to make sure that you submit all of that income documentation. So the pay stubs, the bank statements, the tax returns, all of your pages, not just page one, not just snapshot of your bank statement, the whole thing. Because odds are the problem that you're going to have is going to be on page 5, or the page that you didn't submit, or the fact that your pay stub that was submitted, the last one, most recent one, showed 40 hours, right? But the one from 2 paychecks ago wasn't 40 hours because technically you weren't a 40-hour employee. All of these things are questions that need to be asked, making sure that your lender is doing their digging, and not in a bad way. I mean, just doing their research and making sure that your process is easier for your new home loan. You also want to make sure why you're doing a specific loan. So we all typically right now are doing 30-year fixes, which is great. They have amazing interest rates, right? But we want to also make sure that the one program that we're looking at, whether it's conventional or FHA, or whether it's a USDA loan or a VA loan, that it's the best home loan for you. You want to make sure that the money that you're going to spend is going to go to the right calculation of where it should go. So you're about to spend that 20% down. You're going to, let's say, buy that $500,000 house. You're going to put $100,000 down. Typically, one would think that that's the best route or the best spot for your money. But what if you have 2 car payments? What if you have $40,000 in credit cards? Technically speaking, some of that money is better used on some of that debt. And technically, they could give you more cash flow, meaning that you would have more money not going out of your bank account to be spent on regular bills. Maybe you use that extra money to be able to buy a bigger house because you can qualify for more. That's great. Or maybe you just spend the money to pay off the credit cards to be able to give you other options. You got to make sure that the way that you're setting up your loan is not just generic. I mean, it's not just a 30-year fix with 20% down or a 30-year fix with 3% down. You got to make sure that the way that the mortgage is set up is specified for you and your family. Because what if technically you have the 20% down, but you could use it for something else? What if you buy a home that needs a little bit of work? You could technically not need to spend the 20%. What if you qualify with not spending the 20% and then just spend 10 or spend 3% and then spend the other money somewhere else, whether it's renovating your house or paying off your debt? Okay, so mistake number 4, that is just, I mean, like the big one. Buying a house because the rates are great. Buying the house because the market's amazing and the rates are at their all-time low. I'm sorry, no. The reason why I say this is because regardless of whether the market is amazing, the rates are at the drop low, you have to be financially ready. What if you filed bankruptcy yesterday? What if you were bouncing checks last month? What is going to magically change from the market being amazing and the rates being amazing if you haven't done anything to get you financially ready to be able to buy a home? Don't get me wrong. I'm not trying to defer you or deter you from not buying a home. We have to be financially ready to be able to buy a home. And that means everything, your income, your assets, your credit, all of that's got to be in order before we actually start looking into a home loan. Because a home and a home loan, both of those things are going to have problems. I mean, like, what if your taxes goes up? What if somebody steals something in your house and now your insurance goes up? What if you have an aggressive dog that you just bought a year after you purchased your home? Well, now your insurance is going to be more expensive. What if you have additional taxes that you weren't aware of because your lender didn't set up your taxes correctly and didn't realize you had a Melrose? Well, now your monthly payment's higher. All of this stuff is stuff that's going to affect your actual money that comes out of your bank account. And so it's really important that you're set up for that, set up for the success of being a homeowner. And so when we look at these details, we got to make sure that we've got everything in order. Don't buy a home because somebody's telling you it's a great market, it's the great interest rates, it's great this, great that. We have to be able to control whether it's a good time for us and our family to be able to buy that home. I mean, seriously, would you buy a car just because it's December? You know, and I know that all the new cars come out on the lots in December for the brand new year, for the 2021 brand new model. So then now they got to get rid of all the 2020 models. So you're going to go out and buy a new car because they have brand new ones coming out in 2021 and now the 2020s are like on hot sales? Probably not. You got to make sure you actually need the car, right? We're not going to go spend the money for a car. We don't really need a car. Same concept when it comes to a house. We shouldn't be going out and buying a house when we're not ready to buy the house, or maybe we're not wanting a house. Maybe we could renovate the house that we currently live. Maybe we could do something like what I did, where we were going to buy a house. We were going to buy an upgraded house to be able to have our pool and then have the other bedroom for my other daughter. And then we realized, hey, we could build that here and not go buy another house. So there's options just like that. You got to be sure that we look at all of the options, not just some of the options. So on to mistake number 5. Mistake number 5 is going to be assuming that you're going to be building or obtaining instant equity once you purchase your first home or once you purchase the next home, or assuming that you can just buy it and flip it in 3 years. Unfortunately, that is just not the market that we're in. And truly, we need to be able to assume that we're going to carry and have this home for the long term, for 3 to 7 years, because realistically, you're most likely not going to change your home. I mean, we're at the all-time low, we're having these great values, this great market, but you have to be able to assume that you're going to carry and hold on to this house. And so don't just assume that we're going to have a quick flip for, let's say, the next year or the next 3 months, or let's say 6 months. And the only reason why I say 6 months is because I did have a client that they had the best of intentions. They were buying here in San Diego, and then they saw that they just couldn't afford here in San Diego. So they went to the Riverside County. They went and bought up in Temecula, which was a great idea for them because they were able to afford that home. The problem was that they had not done their research as to how long the drive was from Temecula down to Poway to be able to go to work. And the problem with that is that when you actually do the research and make that drive, I'm talking like on a good day, 45 minutes. On a bad day, you're talking like an hour and a half. And so it took him 6 months to realize that he hated this drive. And by that point, he then had to try to sell the house, which is what his entire objective was. So that way he could buy somewhere else and just have a higher monthly payment and buy in closer to the San Diego area. And when he did that, he ended up losing $25,000 because he had just bought in it less than 6 months before. So he didn't gain all the equity. So when you're buying the first home or buying your next home, it needs to be thought about the long term. So don't just go to another county just because it's cheaper. Go to another county, drive back and forth, maybe stay in an apartment, stay in a hotel, do the drive back and forth for a week, for 2 weeks, to work, to school, things like that. School obviously will end up changing, but to work, because your work's not going to change. And make sure that the drive is something that's doable, because that's going to be something that's going to make you want to sell the house. And it's going to be really hard to sell a house once you just bought it 3 to 6 months before. And if 2020 has shown anything to us, it is unpredictable as to what can happen, whether it's your job, whether it's the house that you're buying, whether it's your employment that's going to change, that's going to allow you to work from home. So you just want to make sure that you kind of anticipate some of this stuff, or at least plan for some of those things that could possibly go wrong. So mistake number 6, which I am going to say is my bonus tip, assuming that you should just work with the lender or the real estate agent that's got the lowest rate and the lowest fees, or that's going to charge you the smallest percentage to sell your house. And so why do I say this? Okay, let's not talk about the house for a second. Let's talk about a big screen TV, okay? Big screen TV is gonna cost you like $2,000, right? You can go to Best Buy. Technically right now, we're probably gonna go to Amazon, because Best Buy and Fry's don't have as much stuff in the stores. So let's say we're gonna go to Amazon, we're gonna order that $2,000 TV, okay? Now, typical thing, it's going to cost you $2,000, okay? That's gonna be the amount of money that you're going to spend. However, what if you had a smaller amount? What if somebody was going to sell it for less? Let's think about this in the house perspective. Typical house, typical agent will sell your house for about 6 to 7% of what the sales price is. So we're just gonna go for easy math here. At $500,000, 6% is $30,000. Remember that this bracket, is very different when it comes to agents and what they sell for and what they don't, or what they charge, and all those details. So we're just doing basic math to be able to compare this factor, okay? So $500,000, $30,000, okay? So $30,000, maybe half goes to one agent, half goes to the other agent. All right, so let's assume that you're going to get this agent to sell your house for 1%, okay? So instead of them charging you $30,000, you get charged $5,000. Awesome. Yes. So exciting, right? This is amazing. Okay, let's think about this. Now let's go back to that big screen TV. You're going to tell me that you would buy a $2,000 TV, right? That is going to sell for 1% of that, $20. You're going to do that? That's kind of the math as to what I'm talking about. When it comes to the math as to really, are you getting what you're supposed to get for the services that you're supposed to get? So with the lowest rates and the lowest fees, when it comes to a lender, sometimes something's got to give. Is it going to be the service? Is it going to be the communication? Are they going to be able to reach back out to you quickly? Are they going to answer your phone call? Are they even going to be available? Then it comes to an agent. Hey, you're not paying 6%. Maybe you're paying 1%. Congratulations, you're saving yourself $25,000. Is that person available to you? Do they answer your phone calls? Do they do the research? Do they help you sell that house? Or are they just putting it on a website and you're just trying to save the $25,000? All of these factors, I know from one case, you think of, well, I'm saving money. And believe you me, I'm all about saving money. But sometimes we've got to see what we're getting for that saving money. Or maybe let's figure out what we're not getting because we're saving the money. And that's where I like to go back to, for me, I like warranties. So because if my dishwasher breaks, I can go make sure that it's going to get covered, right? So I'm going to pay that little extra to make sure that that dishwasher is going to be covered. Well, sometimes you got to pay a little extra to have that real estate agent to make sure that you're dealing with like the best one, right? Or sometimes you got to deal with a lender that maybe doesn't have the lowest rates and lowest fees, but their communication is on point. They're totally on top of it. They explain to you stuff that nobody else explains to you. They break down the numbers that nobody else has told you about. They tell you the honesty, whether you like it or not. And sometimes you just need the honesty. And especially when you're dealing with the biggest investment of your house, of your, like literally your life, it's going to be $600,000, $700,000. Let it be $1 million. Maybe a condo for $300,000. All of those factors are really, really important to be able to make sure that you're working with somebody that you know, like, trust, and that's going to have your back. Because honestly, that's more important than anything. So remember, what are you sacrificing for the lower rate, the lower fees, the lower percentage that is being charged to sell your house? Take a glance at them, take a look, figure out whether it makes sense, because you never know, maybe it doesn't. All right, amazing people. So today we were talking all about the mistakes that you can run into when buying your first home or buying your next home, whether it's the third, the first, or the seventh. And truly, some of these were not so pretty, but it's truly really important to be able to determine which route and which mistakes you want to avoid. And believe me, there is way more that we didn't even discuss today. And if you're thinking about moving anywhere in San Diego, California, you want to make sure to reach out to us. We would love to be able to help you and avoid these mistakes and avoid running into any of the ugly stuff, because that's what we're here for. We got your back when moving to San Diego. We absolutely love getting new phone calls from clients and new families that are thinking about relocating to our sunshine city of San Diego. And if you have a question, or maybe there was a topic that we didn't even discuss, or you're curious about a possible mistake, make sure you comment them down below. I check them all the time, and I'll make sure to reach back out to you and let you know those details. I release videos every single week, so make sure that you click that subscribe button and tap that little bell, because it's really important to be reminded about all the new videos that I release every single week talking about eating, sleeping, living, and playing in San Diego. And let's not forget about the best home loans that are best for you and your family. And so until next time, make sure that you click on one of these videos right over here to get some more information about those best home loans and living in San Diego. And until next time, I'll see you on the next one.